Hello everyone, welcome to the 30th episode of me learning how to trade using Forex. So in the last video we went through the FXCM website, the learn to trade bit on it, and I think we got through all of this section here. And yeah, we're currently just trying to find where to go next, I guess, like from the learning side of this. So I think we were looking at the learning to trade one. So education, we clicked on that, new to Forex, okay. Traits of successful traders, yes, sure, let's do this one. So Forex trading for beginners. Is that what it's called? New to Forex. Let's to avoid confusion. Let's do that. I think we went through the bull one. Oh right, we've done this one. Yep. So that goes all to here. Da-di-da-di-da. Okay, cool. So, best practices of successful traders. Where's the thing gone? What's it called? Best practices of successful traders. And the date is 30th/01/2024. Right. Money management is a core element of successful trading. In this regard, several key traits must be included in a trading plan to boost the chance of success. These include cut loss, let's profit run, use leverage effectively, trade the right time of the day. Money management skills. What was it? Cut losses, let profits run, use leverage effectively, and trade the right time of the day. Trait 1. Successful traders cut losses, let's profit run. This trait is a cornerstone of trading success, however it is one of the most challenging behaviors to incorporate. Nevertheless, without it, the odds of success lengthen significantly. Consider the following table. Percentage loss, 110% break-even percentage, 101.11, percentage loss 20, break-even 25%. If you lost 90%, you need 900% to break even. The more a trader loses, the more it is required to get back to break even. As per table 1, it becomes impossible to recover if too much is lost. Yeah, true. Therefore, to become a successful trader, it is essential not to lose too much money. So we can see that bit's alright, but then this bit is just ridiculous. Trait 1 encapsulates in a metric referred to as the risk-reward ratio. A risk-reward ratio of 1 implies that a trader is willing to risk $1 to make $1, while a risk-reward ratio of 2 means that a trader is willing to risk $1 to make $2. The higher the value, the greater the likelihood of trading successfully. Consider the following example. What do you call it? Let profits run. Known as the risk reward ratio. Risk reward ratio of 1 is equal to risking 1. Let's do £1 to make £1. Risk reward ratio of 2 is equal to risking £1 to make £2. The higher the ratio, the greater the likelihood of trading successfully. Consider the following example. There are two traders, Tom and Jerry. Both take 10 trades, and both score wins on 3 of these. Unfortunately, they also both lose 7 on their trades. Tom's risk reward is 1, but Jerry's is much better at 3. Lose per trade, gain per trade after 7 losses, after 3 wins. The higher risk reward ratio enables Jerry to remain profitable, even though his winning percentage is 30%. An excellent risk-reward ratio relieves pressure regarding a trader's winning percentage of trades. There is a clear relationship between the risk-reward ratio and the winning percentage of trades. Considering both these variables enables traders to tweak their system to run at a positive expectancy. Chart 1 shows the minimum win percentage on the x-axis and the corresponding risk-reward ratio on the y-axis needed to break even, excluding costs. A trader must ensure that they trade above the break-even curve to be profitable. The curve labels show the win percentage first and then the corresponding risk-reward ratio, e.g. 50%. One stipulates that at a 50% win percentage and a risk-reward ratio of 1, a trader will be on the break-even curve, excluding costs, etc. One stipulates that at a 50% win percentage, so that's that, and a risk-reward ratio of 1, a trader would be on the break-even curve. This observation implies that a trader below the break-even curve is incurring losses. To rectify this, they need to adjust their y-axis or their x-axis position. Most traders look for better methods to push their win percentage up. However, professional traders often consider the more appropriate approach is to toggle the y-axis and the risk-reward ratio. This preference is because there is no perfect system and all systems will experience a drawdown period. Therefore, in our above example, if Tom improved his risk-reward ratio, his net position automatically improves, all other things being equal. He may make this improvement through adjustment to stop losses and take profit levels. Okay. Trait 2, using leverage effectively. Many traders come to Forex market for the wide availability of leverage, the ability to control a trading position more considerable than your available capital. However, whilst using high leverage has the potential to increase your gains, it can just as quickly and more importantly magnify losses. In this regard, we refer back to table 1, which is this one here. If leverage results in a significant loss, achieving the break-even percentage is much more difficult. Moreover, leverage may result in a loss size that makes break-even impossible. Given the asymmetry between losses and profits, it should be as little as a surprise that profitability tends to decrease as effective leverage increases. Consider this example. Tom and Jerry each open a 10k account and look to trade EUR/USD MMR $26 per 1k. Both use a 1 to 2 risk-reward ratio with a stop 100 and limit 200. However, they use two different leverage ratios. Above both Tom and Jerry experience the same pip decline. However, Tom's position is highly levered and suffered a much higher loss. Recover from this position will be harder for Tom than for Jerry. So Tom used 30 to 1 leverage, 10 to 1. Buy 300k trade, buy 100k trade. MMR 7,800, MMR 2,600. Usable margin 2,200, usable margin 7,400. Pip value 30, pip value 10. But EUR/USD trades down, falling 60 pips at the end of the trading day. Loses 1,800, loses 600. Remains usable margin 400, remaining usable margin 6,800. Oof. Which trader is more likely to deviate from the initial plan? When the trade went against Tom, it didn't have room to draw down, and the usable margin quickly evaporated, pushing him close to a margin call. Jerry has appropriate leverage and stops and limits to allow the trade space to move back into favour. Ultimately, the same move in the market cost Tom 3 times what it cost Jerry. The higher the leverage, the greater risk on each trade. So this is called the higher the leverage, the greater risk on each trade. Greater risk on each. Besides the financial burden, the heavier losses likely amplifies irrational decision making, i.e. there is a psychological burden as well. As profitability tends to decrease as effective leverage increases. Since profitability tends to decrease as effective leverage increases, the logical result is a positive correlation between the average equity in account and trading performance. So how much money you have in an account against the trading performance. So the more money you have, the better you're performing, and vice versa, the less money you have, the worse you're trading. This result is because undercapitalized accounts tend to assume a leverage position too big to withstand. To this end, we propose a money management formula to align trading position with account size. Whilst the formula is not absolute, and there are other risk management methods, it is a good starting point for traders to test the potential exposure. Assuming a 10k account with a 5,050 pip stop loss, 10,000 times 2% divided by 50 equals 4 mini lots or 40,000 lots of units of base currency. 2% is a risk control mechanism. Large or small accounts may adjust this. However, remember that the larger this is, the harder it would be for recover after a drawdown, as per table 1. Okay. Successful traders. You know what? I'm going to write this formula down actually, because this looks to be effective. To align trade account sizes. So trading account size times 2% divided by pips to stop loss equals number of mini lot position. Trait 3. Successful traders trade the right time of day. Trade the right time of day. Our data on trade performance show that traders on average have a lower win percentage during volatile market hours and when trading through faster moving targets. What is this? Average trader performance decreases of a lower average win percentage during volatile market hours when trading through faster moving markets. But conversely, traders fare better when average pip movements are smaller, yielding high percentage win rates. Traders do better when average pip movements are smaller, which yields higher win percentages. This attribute intuitively makes sense because there is a positive correlation between risk and reward, i.e. the higher the risk, the higher the reward. Or to put it another way, if there is no risk present, it would be impossible to profit. Thus, there is an inherent lure if the risk is present. Traders focus on potential reward, not the actual risk. However, the risk is a genuine and present variable. There are many ways to measure risk, and with one of the most popular being standard deviation or volatility. Deviation when a financial instrument's standard deviation increases, its volatility increases. I.e. its risk increases. As such, there are critical times during the trading day when volatility will increase. For example, in the NFP release, volatility/risk is expected. Moreover, currency pairs have their unique risk characteristics. For instance, JPY volatility will respond to different calendar events than EUR or GBP. Traders should consider the time of day because the volatility increases the chance of loss. If the volatility is extreme, the loss suffered will burden recovery. Therefore, increasing chance of loss. Conclusion. All three traits are linked and connected. Looking after one will have a flow-through effect on the others. Therefore, when a trader focuses on all three qualities, it makes for a responsible approach to trading in the markets. Moreover, trading has become more measured and proficient endeavor. In effect, the trader treats trading as a business, not a pastime. Ooh. Okay. Very good. So we've done that. So we've done the... Why is it so slow scrolling up? Education bit. Become a better trader. Okay, that's just not useful right now. Free online live classroom. Past recording, speakers. Okay, that's not for me right now. What is Forex? Uh, have we done this before? It looks very similar. I don't think we have. Right, okay. Let's do this then. Layout. Below. What is Forex trading? Trading for beginners. Date is 31st 01/2024. Okay, so what is Forex trading? Trading for beginners. Foreign exchange trading, also known as Forex, FX or currency trading. Foreign exchange trading, also known as Forex, FX or currency trading, is a type of financial activity where individuals, businesses and financial institutions buy and sell currencies from around the globe. Is a type of financial activity where people buy and sell currencies from around the globe. Investors trade Forex across what experts consider to be the largest, most liquid market in the world. Forex average daily trading volumes exceeded $6.6 trillion in 2019, according to data from the Bank of International Settlements. How can beginners to Forex trading best launch themselves into one of the most fast-paced markets available? In this guide, learn the Forex trading essentials, including what is Forex trading, what is the Forex market, what is Forex trading for beginners, how to get started, what Forex terminology do I need to know, what are Forex pairs, how does Forex trading work, the pros and cons of Forex trading, how do you start trading Forex, what are Forex trading platforms, what are the most common ways to trade Forex, and what is Forex trading best practice. Read on to take a closer look at Forex trading and discover exciting opportunities that are tough to find with other investments. Okay, so what is the Forex market? The Forex market is a financial market dedicated to the buying and selling of currencies from around the world. Yep, we wrote that down. People use these markets to access currencies other than that used in their home country. They then use this money to purchase goods or services in other countries where their own currency is not accepted. If you ever travelled overseas, you've made this transaction on the Forex market. Take a trip to France and you'll convert your pound sterling into euros. Head to New York and it's sterling for US dollars. While Japan it's yen. These are all known as currency pairs. Wherever you visit, the exchange rate between the currency pair determines how much foreign currency you get for your pounds. This exchange rate fluctuates continuously due to factors including supply, demand, and economic and political events. Single pound on Monday to get you 1.19 euros, on Tuesday 1.20 euros. This tiny 0.84% change may not seem important in the business world. The Forex trading stakes are even higher. Take a large international company that needs to pay thousands of its overseas employees, costing £10 million over the year. Say if sterling's value decreases by 0.84%, that would add 84,000 to its annual wage cost. Capital that would be better used to hire more staff, buy new machinery, or expand into new markets. That €1 change quickly adds up. In both cases, you as a traveller or business owner may want to hold on to your money until the Forex trading exchange rate is more favourable. Past performance. Past performance is not indicator of future results. True. Wow, okay. Wait, so... Oh, this is live. 30th. And this is 31st. What is that? Euro? US dollars? Market one update every 5 seconds. So we can see some candlesticks patterns shown here. Yes. Okay. Volume. What does that mean? Highs, volume, high, low, CO. Euro USD 1 minute day. Take a snapshot. Red, green, red. So that represents the color of the bars. Past performance is not indicator of the future results. Right, okay. What is Forex trading? Since the values of foreign currencies change, it's possible to make money trading Forex. Currencies can be bought when they are cheap and sold when they increase in value. Buy currency when it's cheap, sell them when price increases. Or you can predict whether currency will go up or down in value, making money when they do and losing it when they don't. Forex trading takes place across two levels: interbank markets. This is where banks and financial institutions trade Forex between themselves on behalf of their clients, either to speculate on their changing value or, in case of central banks, as a means of controlling their currency's exchange rate. Over-the-counter market. This is where individuals speculate on the movement of This is where individuals speculate on the movements in currency values via brokers and online trading platforms. These markets typically feature trades not available on the interbank market or are derivatives that do not involve owning or borrowing the currencies themselves, such as CFDs or Forex futures. So I think what we're going to be doing mostly is the over-the-counter market. You can trade Forex in the over-the-counter market via a computer with an internet connection, using a Forex broker to access the market. But how can a beginner enter the Forex market in the best possible way? Forex trading for beginners. How to get started. If you're a beginner at Forex trading, you need to educate yourself on the subject well before you make your first trade. You should fully understand what Forex is, what Forex trading is, how it works, how to read a quote, how to make a trade, understand leverage, develop a trading strategy and place orders upon the market. If you don't, you'll magnify your risk of losing money. Boost your Forex IQ with our free in-depth Forex trading guide below. But don't let your education stop there. Be sure to attend our free morning webinars with senior market specialist Russell Shaw, who's to help you enhance your skills and learn about major economic events around the world. FXCM offers a variety of webinar types, each designed to cater to your trading needs. Daily entries cover the fundamental market drivers of the German, London and New York sessions. In addition, library paths, recordings and guest speakers are available to access at your leisure in FXCM's free online classroom. Learn how to trade Forex and get started below. Learn how to trade Forex, join our live Forex webinars, start trading Forex today. What Forex terminology do I need to know? To learn how to trade Forex, it pays to have a sound understanding of the terms and terminology used by the experts. Right, okay, so I would also need to create like a terminology document just for myself, basically. Yeah, so I think I'm going to create a new Excel sheet and then just copy and paste these in. So position, your forex trading position is the amount of money you have exposed to the market and whether you think it will go up or down in value over time, over a period. If you think its value will rise, you will go long. Fall, you go short. You choose when to close your position, taking your winnings or cutting your losses. If you think the value will rise, you go long. If you fall, and you go short. Leverage. When you trade Forex, you effectively borrow the first currency in the pair to buy or sell the second. Given the liquidity of the Forex trading market is so deep, liquidity providers, big banks essentially, let you trade with leverage, which is expressed as a ratio. If you're trading 200 to 1 leverage, for example, you can trade 2,000 in the market whilst only setting aside £10 in your margin in your trading account. For 50 to 1 leverage, the same trade size would still only require about £40 in margin. This gives you much more exposure in the Forex market whilst keeping your capital investment down. However, if your Forex trading positions fall, you can be liable to pay back a much larger than what you put in. This is what makes Forex trading potentially risky. Margins. The minimum amount you need to pay to open a position. Margins give Forex traders the ability to control positions much larger than their capital reserves. Margin requirements vary accordingly to the currency pair and market conditions. During times of extreme exchange rate volatility, brokers might increase the margin requirements of relevant currency pairs. To better understand the size of margins, use our free margin calculator. Pips. A point in percentage, or pip, is the maximum price movements that a currency pair can make. Pips are standard units that let traders quickly monitor the fluctuation of a currency pair's exchange rate. Most Forex pairs are quoted to the fourth decimal place, or 1 over 10,000, making a pip 0.0001, apart from when the Japanese yen is quoted, the quoted currency, whereby a pip is 0.01. To work out the value of your pip, be sure to use our pip calculator. Quickly monitor most making a pip. Right. Exchange rates. The rate at which one currency can be exchanged for another. Base currency. In a currency pair, the base currency is the one being sold for the other. The first currency named in the pair, so the one on the left. The quote currency. In a currency pair, the quote currency is a currency being purchased, the second currency named in the pair. Bid. The price traders or brokers buy a currency pair for. Ask. The price traders or brokers sell a currency pair for. Spread. The difference between the buy and the sell prices on a trading platform. The lower the spread, the lower the cost to traders. Lower spread typically is a symptom of a more liquid Forex market. Note that the spread of each product varies according to the market conditions. Major pairs. These are the most common Forex pairs, such as EUR/USD. Their price movements are typically not too volatile, and markets tend to have the highest trading volumes. Exotic pairs. These are the least common currency pairs, such as USD, SEK, Swedish krona. They are much more volatile but see lower trading volumes than major pairs. Stop limit order. A stop limit order is an instruction to your broker to close your position once it reaches a certain limit of movement. Stop loss order. A stop loss order is an instruction to close your position if your trade is about to make a loss. Okay. What are Forex pairs? Forex pairs, also known as currency pairs, compares the value of two currencies. The first currency, known as a base, the currency being bought, is priced versus the second currency, quote, showing how much you need to pay in the quote currency to buy one base unit. Typically, each currency is named based on its three-letter ISO currency code, such as EUR for euro. Common Forex pairs include euro to US dollar, pound sterling to euro, and US dollar to Japanese yen. In the first example, a currency pair might be expressed as EUR/USD 1.01700. This would mean that 1 euro is worth $1.0177. Listings of Forex pairs also show traders the bid and ask prices for the currency pair. These are the prices you must pay to buy or sell the pair respectively. The bid price is always smaller than the ask price by a few pips, due to platform charges. This difference is called the bid-ask spread. Typically, spreads are smaller on pairs with higher trading volumes. EUR/USD spreads are lower than those with JPY/HUF, Hungarian forint, for example. Note that the spread of each currency pair vary according to the market conditions. Bid price always asks smaller than the ask price. By a few pips. Okay, so how does Forex trading work? At its most basic level, Forex trading works by buying currencies when their value is low and then selling when they increase. This is done electronically over a trading platform. Forex trades can be made remotely worldwide, 24 hours a day, 5 days a week. Forex markets are open every time zone, so as one closes, another opens. Pacific session, Sydney, 10 PM to 7 AM UTC. Asian session, Tokyo, 12 AM to 9 AM UTC. European session, London, 8 AM to 5 PM UTC. American session, New York, 1 PM to 10 PM UTC. Whenever a trader sends an offer to the Forex market, brokers facilitate the transaction by extending margin. This allows the trader to open new positions far greater than the capital they have at hand to profit from beneficial increases or decreases in price. However, pricing volatility can pose a risk of rapid, significant loss. To complete each Forex trade, the market's technical infrastructure matches contradictory orders from the market makers, individual traders, and the other liquidity providers. There are three ways that Forex is most traded. Spot market trades. The spot market is a main Forex market that sees traders trading currencies over the counter for real-time prices based on current supply and demand. Futures market trades. This speculative trade sees traders enter contracts with one another to buy and sell Forex at a specified exchange rate on a specified date. Future trades are typically performed on a public exchange, for example, suggest to list a UK exchanger. This benefit buyers if the seller agrees to sell at a rate which ends lower than the future exchange rate and vice versa. Forward market trades. Forward market trades are the same as future markets, except that they are traded privately in over-the-counter markets. This means that they are less regulated and customizable. Non-deliverable forwards are a common type of forward and market trade. Spot market, future market, forward market. Note that FXCM only offers leveraged spot Forex trading. What are the pros and cons of Forex trading? Forex market features a unique collection of pros and cons. For any aspiring Forex trader, it's important to conduct adequate due diligence and decide if Forex trading is suitable for you before you begin. The pros of Forex trading. High accessibility, low capital requirements, low operational costs, consistent depth and liquidity, diverse array of products. Cons of Forex trading. Need for discipline. Need for discipline. Pricing volatility. An ever-changing market. Right, okay, so let's read this through then. High accessibility. Forex trades can be done from anywhere via an online platform. Signing up only takes only a day or two, and the market is open 24 hours a day, 5 days a week. What's more, Forex trading only really requires technical analysis or historical price movements, not the in-depth fundamentals of financial analysis required for shareholders. Low capital requirements. If you want to start trading Forex, the availability of leverage means that you can start speculating with many times more than your initial margin. However, remember, that's a double-edged sword, so it could magnify your profits, but it could also magnify your losses, so be wary of that. Low operational costs. Trading Forex typically means you'll be exposed to fewer fees and commissions compared to other types of investing. Consistent depth and liquidity. Forex is the world's largest marketplace. This means that consistent depth and liquidity are all but assured, so you can trade whenever you want. Diverse array of products. As a mature OTC account markets, there are plenty of different Forex markets you can choose from. This provides a great amount of strategic freedom. The cons. Need for discipline. Given the ability of enhanced leverage and abundance of trading options, Forex traders' discipline is frequently tested. It's important to have the right mindset and attitude to risk so you don't get carried away. Pricing volatility. Changes in pricing can be swift and dramatic, posing the risk of rapid, significant losses. An ever-changing market. Past performance is not indicative of future results. Forex trading is always changing, emphasizing the need for sound strategy and strong risk management. Learn more about the pros and cons of Forex trading. How do you start trading Forex? If you've done your research to understand the fundamentals of trading Forex, it's easy to start. Step 1. Open an account. Open an account for Forex broker, inputting your personal details. It will take anywhere between 1 to 3 days to get fully set up and ready to trade. Step 2. Pick a pair. Select the currency pair that you would like to trade, a major pair like the UR/USD or an exotic pair like the JPY/SEK. Step 3. Set your orders. Choose whether you wish to place stop or limit orders on your trade. Step 4. Keep an eye on your position. Stop using trading tools. Monitor the movement in your currency's pair price. In doing so, you can sell or buy at the correct time. Keep your eye on your position. Step 5. Close your position. When the time is right, close your Forex trade and realize your profits or losses. trading. Step 1, open an account. Step 2, pick a pair. Of currency. Step 3, set your orders. Step 4, keeping an eye on your position. Step 5, close your position. So I think that's done. What are Forex trading platforms? A Forex trading platform is a trader's window to the world's currency marketplace. So A is the trader's window to the world's currency marketplace. To be effective, your trading platform must be up to the many challenges of the live Forex market. At FXCM, we offer a collection of capable and reliable Forex trading platforms, each with unique features and functionalities. Our flagship platform, Trading Station, gives you everything you need to execute trades, perform in-depth technical analysis, and access your account whenever you need to. We also support the industry standard MetaTrader 4 software and assorted specialty platforms. So no matter what your approach to Forex trading may be, rest assured that FXCM has your needs covered. What are the most common ways to trade Forex? Unsure which strategy to use while learning how to trade Forex? Here's the main ways the traders make money. Day trading, position trading, scalping, and swing trading. Main ways. Position trading, swing trading, scalping. So day trading. Short-term day trading involves starting and completing a single position within a day. It's a straightforward way to trade, giving you lots of time and mental breadth to research and monitor trade before closing a position in time. Read our guide to Forex day trading. Position trading. This long-term Forex trade involves holding on to a pair prolonged periods, waiting until it reaches a certain price level weeks or months into the future. It's great if you don't have plenty of time to spare or want to spend trade based on larger long-term economic factors. Swing trading. A medium-term strategy. Swing trading involves holding out a pair for a few days and selling it when the price swings in a manner consistent with the historical price charts and other forms of technical analysis. Scalping. Scalping involves holding trades for a matter of minutes, profiting a small amount but highly frequently. This form of Forex trading requires plenty of time, so suits traders who treat Forex as their day job. Wow. How much time I got left? Oh, okay. I guess I'm going to leave this episode here then. So, yeah, thank you guys for watching. In the next video, we're going to be going over what is Forex trading best practice. So, yeah, see you then. Peace.